Professional ethics are a set of principles and values that guide the behavior and decision-making of individuals within the accounting profession. For financial auditors, maintaining high standards of professional ethics is of paramount importance due to the nature of their work and the level of trust placed in their judgment. Financial auditors are responsible for evaluating and verifying the accuracy of financial statements and information provided by the audited entities. The credibility of these statements heavily relies on the integrity of the auditor. If auditors lack professional ethics and engage in unethical practices, it can erode the trust of stakeholders, including investors, regulators, and the public in the financial reporting process. Auditors must approach their work with objectivity and impartiality. Ethical behavior ensures that auditors are not influenced by personal biases, conflicts of interest, or undue pressure from management or clients. Maintaining independence from the entities they audit helps auditors provide an unbiased assessment of financial information, which is essential for accurate decision-making. Auditors have a responsibility to serve the public interest by promoting transparency, accountability, and accuracy in financial reporting. Ethical auditors prioritize the needs of stakeholders and contribute to the overall health of the financial market. In sum, professional ethics are essential for financial auditors to uphold their responsibilities with integrity, objectivity, and accountability. These ethical principles not only ensure the quality of financial reporting, but also preserve the credibility of the auditing profession and the broader financial ecosystem. An ethical problem in the context of auditing refers to a situation where auditors encounter a dilemma that involves conflicting interests, values, or principles, and they must make a decision that aligns with their professional ethics. One common ethical problem in auditing is the issue of auditor independence. Let's explore this further. Suppose an auditing firm is engaged to audit the financial statements of company XYZ, a publicly traded company. The auditing firm has a long-standing relationship with company XYZ, providing not only audit services, but also consulting services for various non-audit matters, such as IT system implementation and tax advisory. In this scenario, an ethical problem arises concerning the auditor's independence. Auditor independence is the cornerstone of ethical auditing practices, as it ensures that auditors remain impartial and unbiased when assessing an entity's financial statements. The conflict lies in the fact that the auditing firm is providing both audit and non-audit services to the company. This raises concerns about whether the auditing firm can maintain its objectivity and independence while evaluating the financial information it previously had a hand in consulting on. The fear is that the auditing firm might be influenced by its consulting relationship, which could compromise the integrity of the audit. To address this ethical problem, auditors need to carefully evaluate whether their non-audit services create a significant threat to their independence. In many regulatory frameworks, there are specific rules and guidelines that outline what types of non-audit services can be provided to audit clients without jeopardizing independence. The ethical decision-making process involves a systematic approach to addressing ethical dilemmas and making choices that align with one's ethical values and principles. First, an auditor must recognize when there is an ethical dilemma. It is important to identify that there is an ethical problem or dilemma that requires a decision. This involves understanding the conflicting values, interests, or principles involved. For example, a financial auditor is auditing a company that is a close friend's business. The auditor discovers financial irregularities that need to be reported accurately. However, reporting these irregularities could potentially harm the friend's business and strain their personal relationship. When faced with an ethical dilemma, it is essential to define all facts and circumstances in the ethical decision-making process. This refers to gathering and comprehensively understanding all relevant information, details, and contextual factors surrounding an ethical dilemma. This step is crucial to make an informed and balanced decision that takes into account the full scope of the situation. It helps avoid making hasty judgments based on incomplete or biased information. Defining all facts and circumstances provides a foundation for a well-informed ethical analysis and decision-making process. The next step in the ethical decision-making process is that of identifying stakeholders. In the context of an audit, this involves recognizing and understanding the individuals, groups, or entities that have a vested interest in the audit process and its outcomes. By identifying stakeholders, auditors can consider their interests, rights, and concerns and make decisions that align with ethical principles and address the needs of these stakeholders. Identify all the parties who are directly or indirectly affected by the audit process or its outcomes. Stakeholders can include company management, who are responsible for financial reporting and ensuring the accuracy of financial statements, stakeholders and investors, who rely on accurate financial information to make investment decisions, regulatory authorities, who require reliable financial statements for regulatory compliance, employees who have a vested interest in the financial stability of the company as it can impact their job security, creditors who rely on the financial information as it affects decisions to extend credit, the audit firm upholding their professional standards and reputation is vital, and the public who rely on accurate financial information for confidence in the financial markets. It is important for auditors to also understand the stakeholders' interests and concerns. For each stakeholder, they should analyze their interests, rights, expectations, and potential concerns regarding the audit. Understand what information they rely on from the audit and how it affects their decisions. For example, consider an external audit of a publicly traded company. In this context, company management would be interested in ensuring a clean audit opinion to maintain investor confidence and regulatory compliance. Shareholders and investors will need accurate information to make informed investment decisions. Regulatory authorities would require assurance that financial statements comply with accounting standards and regulations. Employees would be concerned about the company's financial stability because it affects their job security. Whereas creditors need reliable financial statements to assess the company's creditworthiness. Audit firms are interested in maintaining independence and professional integrity, and the public relies on accurate financial reporting for the trust in the capital markets. The next two steps involve identifying alternative and consequences, and then choosing an alternative with respect to the consequences of that alternative. In evaluating or identifying alternatives and consequences, auditors must assess the pros and cons of each option in terms of how well they align with ethical principles, their potential impact on stakeholders, and their feasibility. Recall the earlier example where financial auditors auditing a company that is a close friend's business and discovers financial irregularities that need to be reported accurately. In this situation, the auditor would evaluate the potential consequences of reporting the irregularities, including the impact on the friend's business, their personal relationship, and their own professional reputation. The auditor would then, based on those alternatives, make a decision, select the option that best aligns with ethical principles, taking into account the information gathered and the potential consequences. Consider the decision that they can justify and defend based on ethical reasoning. For example, after careful consideration in the above scenario, the auditor decides that the most ethical choice is to report the financial irregularities accurately to maintain their integrity as a professional auditor. In the example presented, the financial auditor goes through each step of the ethical decision-making process to navigate the conflict between their professional responsibilities and their personal relationship. By following this systematic approach, the auditor arrives at a decision that upholds ethical principles while fulfilling their duty as a professional auditor. As indicated, Auditors have to recognize when there is an ethical dilemma and go through the steps of trying to resolve the ethical dilemma and reach a conclusion that is consistent with ethical principles. Moral intensity refers to the degree to which an ethical issue or dilemma is perceived as having moral significance. The concept includes 6 components that influence individuals' perceptions of the moral implications of a situation. These components help individuals determine the level of ethical concern and guide their decision making. Magnitude of consequences is a component of moral intensity that refers to the potential harm or benefits that could result from a decision or action. The more severe the consequences, the higher the moral intensity. In an audit setting, an example would be an auditor discovers evidence of significant financial fraud in a company's financial statements. If the fraud is not addressed, it could lead to substantial financial losses for shareholders, loss of investor confidence, and potential legal repercussions. The second component, social consensus, considers the extent to which society agrees on whether an action is morally acceptable. If there is a strong societal consensus, moral intensity increases. In an audit example, an auditor is asked to overlook certain irregularities by the company's management. If the company is known for ethical violations in the past, and there's a strong societal consensus against such behavior, the auditor may feel greater ethical pressure to report the irregularities. The third component is probability of effect, which reflects the likelihood that a particular outcome will occur. Higher probabilities lead to a greater moral intensity. In an audit setting, for example, during an audit, the auditor identifies weaknesses in the company's internal controls that could potentially lead to financial misstatements. If the auditor determines that the likelihood of such misstatements occurring is high due to inadequate controls, the moral intensity of addressing this issue increases. The fourth component is temporal immediacy. This refers to the time delay between an action and its consequences. Immediate consequences tend to raise moral intensity. Extending that to an audit setting, an example would be an auditor uncovers evidence of improper revenue recognition that has been ongoing for several quarters. The longer the misstatement persists, the greater the potential harm to investors and the company's reputation, increasing the moral intensity to address it promptly. Proximity is the fifth component and refers to the psychological and physical closeness of the decision maker to the consequences of their actions. The closer one is to the effects, the higher the moral intensity. An example in an audit setting would be an auditor being asked by a close friend, who's also the company's CEO, to overlook certain financial irregularities to avoid damaging the company's reputation. The proximity of the relationship between the auditor and the CEO can heighten the ethical dilemma and moral intensity of the situation. Concentration of effect represents the sixth component and considers whether the consequences affect a few individuals deeply or a larger number of people less intensely. A higher concentration of effect increases moral intensity. Extending that to an auditing example, an auditor is aware that the company's financial misstatements might lead to a small number of senior executives receiving significant bonuses based on inadequate performance metrics. The concentration of the effect on a limited group of individuals increases the moral intensity to rectify the misstatements. In each of these examples, the components of moral intensity play a role in shaping the ethical considerations and decision-making process of the auditor. By evaluating the magnitude of consequences, social consensus, probability of effect, temporal immediacy, proximity, and concentration of effect, Auditors can better understand the ethical significance of the situation and make choices that align with their professional responsibilities and ethical principles. Ethical positioning identifies 4 distinct ethical orientations that individuals may adopt when facing ethical dilemmas. These orientations reflect different approaches to making ethical decisions based on personal values and principles. Each orientation emphasizes different factors when evaluating right and wrong. The 4 ethical orientations are as follows. Absolutists believe in rigid, universal, ethical principles that apply regardless of the situation or context. They prioritize ethical rules, standards, and duties over situational factors. For them, there are clear rights and wrongs that should not be compromised, regardless of the consequences. For example, an auditor adhering to an absolutist orientation would refuse to overlook any financial irregularities discovered during an audit, even if doing so could potentially save the company from financial distress. They would argue that their ethical duty is to report accurately, regardless of the consequences. Relativists emphasize the importance of context and situational factors when making ethical decisions. They believe that right and wrong are influenced by cultural norms, personal beliefs, and circumstances. They're more willing to make ethical compromises based on the situation. An auditor with a relativist perspective might consider the financial irregularities discovered during an audit within the context of the company's financial difficulties. They might decide to report the issue to management while also considering potential corrective actions that could mitigate the consequences. Exceptionists are willing to make ethical compromises in certain situations, but only after careful consideration and justification. They believe that ethical principles are generally important, but can be overridden in exceptional circumstances where the consequences are significant. For example, an auditor with an exceptionist orientation might report financial irregularities to management, but under specific conditions, consider working with the company to rectify the issues before reporting them to regulatory authorities. They would justify this approach by balancing ethical principles with the need to prevent potential harm. Situationists prioritize the overall well-being and greatest good for the majority when making ethical decisions. They believe that ethical actions are those that lead to the best overall consequences, even if they involve violating certain rules or principles. For example, an auditor with a situationist perspective might consider the potential harm to shareholders, employees, and the public caused by immediate reporting of financial irregularities. They could decide to work with management to rectify the issues first, ensuring the best overall outcome before taking further action. These ethical orientations provide insights into how individuals approach and rationalize ethical decision-making. People may lean more toward one orientation in certain situations while adopting a different orientation in others. The choice of ethical orientation can significantly impact the way individuals approach ethical dilemmas and the decisions they ultimately make. In the accounting profession, standard-setting bodies and professional organizations play a vital role in establishing and maintaining codes of ethics that guide the behavior and decision-making of accountants. Here's how these principles apply to the accounting field. Setting ethical standards. Accounting standard-setting bodies, such as the International Accounting Standards Board and the Financial Accounting Standards Board, work to establish ethical standards for financial reporting and auditing. These standards ensure that accountants accurately and transparently present financial information to stakeholders. 2. Ensuring professional conduct. Professional organizations like the American Institute of Certified Public Accountants, known as the AICPA, and the Chartered Professional Accountants, CPA, associations around the world define codes of ethics for accountants. These codes outline the expected behavior of accountants, emphasizing integrity, objectivity, confidentiality, and professional competence. 3. Providing guidance. Codes of ethics for accountants provide guidance on how to handle ethical dilemmas that may arise during financial reporting, auditing, and consulting engagements. They help accountants make consistent and ethical decisions in complex situations. 4th, upholding public trust. Maintaining the trust of investors, regulators, and the public is paramount in the accounting profession. Codes of ethics reinforce the importance of transparency, accuracy, and impartiality in financial reporting, enhancing public confidence in the profession. Adapting to changing landscapes. Accounting standards and ethical considerations evolve to address new financial instruments, technologies, and business practices. Standard setters and professional organizations update codes of ethics to ensure they remain aligned with the changing business environment. Educating professionals. Professional organizations provide resources, training, and continuing education opportunities to accountants, helping them understand and apply ethical principles effectively. This education ensures that accountants are well equipped to make ethical decisions throughout their careers. Enforcement and disciplinary actions. Professional organizations often have mechanisms to enforce ethical standards. This may involve investigating complaints and taking disciplinary action against accountants who violate ethical codes. Such enforcement underscores the seriousness of ethical conduct in accounting. Finally, promoting continuous improvement. Codes of ethics encourage accountants to engage in ongoing professional development and self-assessment. Professional organizations offer resources to help accountants stay current with evolving standards and best practices. In the accounting profession, the collaboration between standard-setting bodies and professional organizations ensure that accountants adhere to high ethical standards when preparing financial statements, conducting audits, providing financial advice, and engaging in various other activities. These codes of ethics help accountants maintain their credibility and contribute to the overall health and transparency of financial reporting worldwide.